Brad, give me a minute on this one. You took the time to type it. I want to take the time to read it correctly. Okay, Brad says, using power options, was it a good way to take a long call that I have to search for options to sell a shorter expiration against long? I've been using the calendar call search, but this doesn't consider that my long option has profit already in the setup. Additionally, the position analysis doesn't show options. It should, but it depends on the gain, Brad. But you gave me the great example. You've got TGT, January 230 call, purchase for 19. You want to see what makes sense to sell a call against it. Fantastic. All right. So I'm going to go to the portfolio first, even though Brad told us that there is no rollouts there for his long call position. So let's put in the long call. TGT. Jan 230 at 19. Stock price time of trade is irrelevant. Let's just say we did this on October 1st, Brad. That's irrelevant too. But we'll just put that in. Whoop. Keep the math simple. Use one contract for our examples. All right, now what is Brad talking about? He's got a long call here that he's got a 14.2% profit on the position. He wants to reward himself for picking the right one and sort of lock in some of those gains by creating a calendar or diagonal spread, setting a near term, weekly October maybe, or first week in November, call against it to lower the initial cost basis there and get some premium. And the stock, of course, is at 245.71. So depending on his outlook for the position, he's probably considering a 250 or 255 few weeks out, maybe 2 to 3 weeks out in time. Okay. Now, in this case, I could go to position actions and position analysis, and we're not going to see any rollout opportunities in this case. Okay. So the no rollout opportunities can be identified for your position based on the criteria that we use. We can try to simply now just go to the profit and loss chart. Find that easier to do. We could just go to the option chain for TGT and look at the prices of those 250, 255 calls for October 22nd, October 29th, November 5th, November 12th, and see which one matches what you want. Or we could just build it on the fly through the custom spread tool, and that's normally what I would do. So Brad, I'd go here to TGT, got the 230 call. General, when I'm selling a call against the calendar, I want to follow the same general rules. I want to keep it shorter term, maybe just 2 to 3 weeks out in time to get a maximum annualized return. I want to pick a strike where I don't think TGT will hit based on my analysis. So I might just start off in this case and go along to October 29th, 14 days out, of course. My 250 is at $1.58 by $1.75. The 250 is at $1 by $1.14. Okay, not too high in price, but again, I'd also want to know what's coming up with TGT. I haven't checked to see if there's earnings coming up between now and November expiration or now and these October expirations. I'd want to know that before selling the call in this case. But let's just check out the 250. It's got a better price. We're going to get about 162, 163 at midpoint if possible. How is that going to change the dynamic? Well, it is going to lower my cost basis, Brad, but it's also going to cap the gain. Okay. All right. So what do we have now? We have a position we saw before. We have a position. I'm sorry. Let me go back here. We have a gain of 270 or 14.2% on the call right now. This would increase the potential return potentially if TGT is right at 250 to 738, and we've lowered the cost down to 1733 from that $1.65, $1.66 we collected against the position. Okay, so this is what the outcome would be if you feel that in the next 2 weeks TGT might stay below 250. If you think it's going to blow above that, you might want to go to the 255 and just go further out in time. I know it's manual, but you can do it in this fashion. And so it's still a good increase in monetary return, and it's still a good increase in percentage return from 270 and 14.2% where you're at right now. But again, remember the dynamic of the diagonals. And I know you know, Brad, but I feel that I always have to bring this up for new investors that might be joining us today that are considering diagonal spreads. This return, it's not like a covered call. A lot of people teach the diagonal spread, whether you're legging into it as Brad's doing or you're opening it up from the beginning. If you could get that cost, your cost here would be $21 in this case. Oh yes, I'm going to get to that too in just a moment. One of our customers, favorite regular attendees, just mentioned a comment that I haven't addressed yet that I'm going to look at that just a second too. A secondary rule, Brad. Okay, so there we go. This is showing me that this is the projected return if the stock's trading right at 250 on October 29th expiration, the date of our sold call. Okay? This is a theoretical return based on the Black-Scholes pricing model of what the Black-Scholes model shows us, what the long call value would be worth if the stock is trading right at 250 on October 29th, 14 days from now. That can shift, okay? This isn't etched in stone. What do I mean by etched in stone? Well, investors who are familiar with a covered call, if I bought TGT at 230 and I sold the 250 call and the stock stays above 250 or goes above 250 and I get a sign, it doesn't matter if it goes to 260, 270, 290, 300, I'm going to make that maximum return. For the question that came in, I'm sorry, from, it wasn't Chuck, was it? It was Charles. I'm sorry, from Charles about this calendar spread. I can tell it is in the right structure that I would use because it doesn't double dip into loss. And with the wrong structure, but even in the right structure, what's happening here? The maximum profit on the position tails off as that short call goes deeper in the money. And again, why is that? It's because the shift in delta. When I would have opened this position, if I opened it fresh right now and bought the 230 January call and sold the 250, I'm probably looking at a delta here on the 230 call of maybe 0.6 or so, and this one at the 250 strike might be at 0.4 or 0.3. I have a positive delta ratio, the delta of the long divided by the delta of the short, so that every dollar the stock moves up, I'm gaining more on my long call than I might be losing in the sense of buying it back on the short call. But as we get to expiration, how does this trail off? Because as we get to expiration, closer to expiration, the delta of this option that's expiring in 2 days, 1 day, 1 hour is doing what? It's going closer to a delta of 0 if the stock's below it, or a delta of 1 if the stock is above it. This is still probably hanging around. If this, let's say the stock does go up to 252 on October 28th, this delta is probably at 0.95, 0.96 on my short option that I have to buy back. This one's probably hanging out at 0.7, assuming it's at 0.6 right now, or 0.65. It's at a 0.7, and if it keeps going up, this is going to 1, but this is just going to 0.72, 0.73. So that positive delta ratio I had when I originally opened the calendar spread or created the calendar spread is now reversed. I'm losing more on the short call than I'm gaining on the long because we're so close to expiration, and that's just going to our delta of 1. It's now a reverse delta ratio. That's why it trails off, and that's why I want to warn investors that might be new to this but sort of like the structure. I like the structure. I like to use it on higher price stocks, absolutely. But again, not to Brad's direct question, that it tails off. And in some cases, in the wrong structure, it can be a loss. So we think as a covered calls trader, hey, as long as the stock is trading above these strike prices, I'm going to get that max return of 42.6. No, it tails off. And it can be a loss if it goes really high if you don't have the right structure. What is the right structure? Charles had mentioned, he said to me, Mike, you want to make sure that the total debit now of 1733 is less than the difference in the strike prices. And it is. I didn't check that first, but that is something, Brad, you'd want to analyze. Why do you want the new net debit after you've sold this call to be less than your difference in strike prices? Because if the stock suddenly shot up, something really good comes out on TGT and the stock just suddenly shoots up to 320 in that case, you may be assigned early on this short call. That obligates you to deliver shares of stock you don't own. Your broker would likely exercise the 230 call for you to buy the shares of stock at 230, sell them at 250, you'd get $20 back. That's not $738, is it? No, you're up here. We're making $300, $360, $265 in that case, because we only got 20 back and we had a debit of 1733. So we make 267. I'm talking about way up here in the 320 range. It keeps tailing off as we go further. This return, of course, is based on being able to sell to close the long option for the remaining intrinsic and time value it still has at this peak. If you exercise it, you won't get that higher return because you're denying yourself the time value from October 29th to January that still exists in your call option. And so that's why, if, as Charles mentioned, it couldn't have happened in this case because your debit was only 19, but if you had paid $22 for this and sold this for $165, your debit's going to be around $20.40. Okay, total in the position, something like that. And you only have a 20-point strike difference. So that's where you'd see the improper structure because the total debit is higher, than the difference in strike prices. So in that case where you were assigned early, you'd actually be losing money on the position. So when you do this analysis, Brad, and I know it's manual, but you probably had a target in mind of what you'd already sell. You're in the position analysis view for TGT. And you don't see any rollout opportunities. Click on profit and loss chart, and then we can check the expiration that we want. Let's go to November 5th. Remember the 5th of November. And you can see the different strikes. Say, what would the 255 call? Give me a little bit more oomph, not as much profit, but give me a little bit more upside. Let me sell that against it. Okay, what do I get here? All right, we get our new profit and loss chart. We know what's here. We can calculate the profit and loss chart, but remember, if implied volatility shifts on this farther out call, your expected profit could be less than expected because it's based on the theoretical pricing model for that position. Okay, and again, where are we now? We're at a 25-point strike difference. So yes, make sure to check, Brad, that the new debit you have in the position is less than the difference in strike prices there. And you'd know it right away if you just built it on the fly. If you see the upper leg go into negative, that means your net debit is greater than the difference in strike price, and you could lose if it shoots up that far. Okay? All right. Now, while I'm here, and yes, David has another question. He says, if you have time, yeah, we're going to cover that. You guys asked a few more questions here. I'm going to cover those all for David, Fernando, and Sal. And I'm going to do Fernando in a moment. So, and it would work better in Fernando's situation too. I'm going to cheat a little bit, ladies and gentlemen, and I apologize. We know that this price is at $21.70, and I'm going to check three prices here. I'm not sure which one it is. We're going to edit this position. We bought it at 19. It's at $21.70. Got a gain of $270 there on Brad's position. Excellent. Those are some ideas to analyze the calendar. Now, $21.70. Let's say that I got into this position earlier. I'm going to try 13, maybe 14, but I'm going to try $13 here in that case. So we're going to say we bought it at 13. That's too high. I'm sorry. Math wasn't working in my head. I'm looking at an $8 profit on 21, not, against the 13 cost basis. Let me change that. I'm sorry, folks. Let's go back up to 16, or 15.50. Okay. So we're going to put in, we paid $15.50 for this position. That's going to give us a reflection of a 40% profit. I'm not sure if this is the trigger, guys, so just bear with me in 1 second. Position actions, position analysis. Okay, still none. That's fine. Bear with me 1 more second. I'm going to go back to 13, maybe 14. All right, now I've got a 55% gain on the position. Go to position actions and then position analysis. There we go. All right, so Brad, that's the trigger. The trigger is a 50% profit. When you have a 50% profit on the long call, you'll start to see rollout opportunities for selling the 250 call against. I'm not saying you should do that and create a new position, a paper trade position that has a 50% profit. But this is when you'll start to see rollout opportunities. Oh, these ones are for rolling for a higher strike. Okay, normally I'd see call ones that come in here as well. Once my long call hits a 50 to 60% range in the profitability. You'll see too. This is rolling up the call to have a lower maximum risk. Take your profits off the table in that case and roll to a higher strike. The 240s, the 250s, you have less of a monetary risk on the position. You're pocketing some of the profit right now. That is another approach. Another approach to consider in this case, Brad, I'd wait till it gets higher. You know, if I get up to a 40 or 50% gain on my long calls, I hope you get there too. I really do. But if I hit that point, you're absolutely right. I might sell half. If I had 5 contracts or if I had 6 contracts, I'd sell 3 and then convert the other 3 to a calendar spread. So I'm pocketing half the gain, so I have less exposure in the market on the remaining long calls. I'm going to point you something to that in just a moment. Going back to the 2 things here for the initial position thoughts. Robert just mentioned by purchasing a call in a far distant expiration at 70-80 delta and then selling a near-term call, you will have a lower but less volatile return. Okay, so he's talking about that. He says, I do this rarely as a stock substitute. So yes, and there's a lot of investors that do that. And these higher price stocks, I mentioned to Stefania in our last discussion 10 minutes ago about how I like to use the calendar spreads and the long calls too, but calendar spreads on the higher price stocks. Because the first thing I do on the married put screen is reduce the cost basis down to $85 for what I can afford to purchase in a married put for my portfolio. And as I have more positions, I'm going to lower it down to $40 or $50 just to see the positions that match my married put criteria. I can't afford right now to do a married put on TGT, but I might do the calendar spread or sometimes what's called the stock replacement, sort of as Robert just mentioned in that case, as an approach to do it. 70-80 delta, far out in time, selling near-term calls against it. And this is more of a repair position that we're looking at. Back to just the main profit and loss chart. Here, let me submit that. Fernando, of course, mentions another way that you could consider. Sorry about that. That was based on the short call strike price. That's why I was so short. You could also consider buying a put option to lock in the gain and maybe trade the stock inside of the strangle. Yeah. So what he's talking about is you could buy a put to sort of create a strangle position. You might be able to lock in some of the profit. Let's just take a look at it. But I would wait for a higher gain, and I think you would, Fernando, too. In this case, if I was up to that 40 or 50%, that's usually when you see you can lock in most of the profit at just a 14, 15% gain on the long call with what we're seeing on these prices here for TGT. Because we know earnings are coming up sometime between now and expiration, which would be a great time to add in this strangle. If I just paid $390 for the 220 put, we create that strangle. The risk is 2,300 though, and it's 20. Yeah, we're up here, but we've removed sort of the gain on the position. Maybe I should buy an in the money put in that case, but it'd be very expensive. We wouldn't be able to lock in too much less. I'll wait to see a bigger gain in that case. Fernando, before doing that strangle, maybe on that 50 to 60% one, if we had got this, let's check it out. If we had bought this at 14, now the stock's moved up to 245. Might consider, I'd keep the same expiration just to keep this part of the discussion simple. Let's go to 250. And we're buying a slightly in the money as I would with a married put. It's really at the money, so the time value is going to be the highest. Probably not the best approach. Max risk lowers to 860 from the original 1400, and that's anywhere between 250 and 230. So now, though, we need a much bigger gain to get back to that 14% return. We're up to the 260 to 265 range. So I want to see more profit, Fernando, before I did, more unrealized profit before I did that. Okay, now I'm going to get to David H. and Sal in just a moment, but I'm going to pause the screen for a minute. Okay, so back on YouTube now. And for Brad here, what we want to do is just on the PowerOptions videos, I'm not logged in. You don't have to be logged in. Just go to YouTube. Find us on YouTube as always. Go here. I'm going to do a search for, I think I've called it profitable long call. So I'm just going to search for profitable long, and there it is. When you have the time later, Brad, check out some ideas. It goes over what we just talked about with turning it into a diagonal spread, selling half and turning it into a diagonal spread, selling half and turning it into the strangle that Fernando mentioned, or just turning it into the strangle. So we review the 8 ways to manage a profitable long call in a position. That'll give you some further ideas. But for your direct question, when you go to the position analysis view, and you don't see any rollout opportunities or the rollout opportunities you potentially wanted on a position, you'll have that link for what if calculations, or if there's no ones here, say go to profit and loss chart. Just go to the profit and loss chart there, Brad. And again, put in your view options, and you can go ahead and do that. But a great review that covers some of the stuff that Fernando's mentioned and other things we didn't mention too much here today. 8 ways to manage a profitable long call, 27 minutes, full discussion on comparisons of different ways you might consider to manage that profitable long call position. Fantastic. Great question, and I'm glad we got to walk through that.